Inventories are a very important part of working capital management of a business. Most of the businesses who buy and sell, they have more than 50% of their working capital is stuck in inventories. However, this element of working capital is not important for the businesses who are in services sectors. For example, airlines or IT services providers. Inventories are normally not an issue for them, hence they don't have problem in this area. However, those businesses who are in manufacturing businesses or buying and selling businesses, most of their working capital is stuck in their inventories. Now, why is this the case? Why do they have to spend so much money on inventories? Well, businesses who buy and sell, they exist to sell. So they can't sell if they don't have anything in stock. So what they try to do, they try to keep as much stock as possible so that they can fulfill orders whenever a customer requires. If they don't have products to sell in stock, then they fear that the customer would go to another supplier and they will lose their customer. So this is the primary reason that businesses have so much money in inventory. However, there are so many problems associated with keeping inventory. So it's an essential evil which businesses who buy and sell or manufacture have to keep. There are three major types of cost which are associated with inventories. First of all, the cost of purchasing the inventories. That is obvious. Whatever you spend, you can keep, and normally you can keep, or either you can invest in your long-term assets or machines which can produce more for you, or maybe if you borrow that money to buy inventories, you don't have to pay interest on that. So that is an obvious cost. The second related cost is holding up the inventories. So think about all those big businesses like Amazon, Sainsbury's warehouses, Tesco's warehouses, where they keep their stock. Now all of that stock needs to be kept in a place. So a warehouse cost are big cost. Then insurance, rent rates, etc. These are the costs which are associated with it. And then they need staff to actually manage those inventories, to rotate those inventories, to put them on the shelves, take them out, and so on. So there is a lot of cost in holding the inventories. And the third cost, which is incidental to holding the inventories, is you could damage your products. Your products can go out of date. The products could get stolen. So these are also the costs which are associated with holding inventories. Therefore, it is very, very critical for businesses to work out how much inventories they need, where they are striking this balance. And the balance is that they do not run out of the inventories when a customer orders, but then they do not have too much inventories that they have to keep them in their warehouses and pay cost on keeping those inventories unnecessarily. So it's a question about not having too much and too little, just striking the right balance. And luckily there is a formula which can actually give us that figure, and that formula or that equation is called economic order quantity. This formula tells businesses how much should be ordered each time. So if you're selling a product and you're buying it from the manufacturer, the quantity, it would tell you, which would reduce your cost. The formula says Q equals whole square root, and below the square root you have 2 into D into O divided by H, where Q is economic order quantity. This is the quantity we should order when we make an order. So that is our result. Then demand for inventory items in the period. We need some historical data on this matter. Cost per order. Whenever we order, we have to pay some delivery cost. How much cost business have to pay to keep each unit of that item in the warehouse or on the shop shelves, whatever the total holding cost is. We will now look at an example, which is to calculate EOQ. Bullfinch Supplies Limited uses the EOQ formula to determine the optimal size of inventory orders. For one of its most popular lines, the following information has been established by the company's management accountant. Demand for the item in the period is 5,000 units. This period could be a month or a year. Cost per order: every time we make an order from the supplier, they charge us £25 to deliver, for example. And then holding cost per unit is £17. This holding cost would be warehouse rent, rates, insurance, shelf price, and then the staff cost associated with maintaining that cost. You'd be surprised to know that each of those warehouses actually have calculated how much does it cost them on maintaining or keeping an item on the shelf. Slide 2 of the example, we will apply the EOQ model, and we'll put the figures in the formula. Q equals 2, which is the constant of the formula. 5,000 is the D for demand, and 25 is our ordering cost, divided by £17, which is our holding cost, and the figure comes up as 121. This is our order size. We should order 121 units every time. However, in reality, things may not be the same. It could be that we have to order different sizes because of the supplier's rule. They would not allow less than 200 orders at a time. So we have to order 200. Or maybe they're offering discounts. If you order 150, you get 5% off. In that case, we have to work out a bit more. This formula is important for your exam. You will see plenty of questions in the chapter test. So that's all which we need to cover about the inventory. The next video will be on the management of receivables. So I'll see you then.